everyone, and welcome to Power Hour. My name is Brandon Wendell. I'll be your host for the next hour. Obviously, got Rob on the phone on the screen there, but he is out on vacation, I believe. So I'm filling in for you guys right now. And I apologize for the noise in the background. Unfortunately, they're doing some work on my seawall outside. They're raising it because of flooding. So we're getting that changed a little bit here. So hopefully you guys can hear my voice and see my screen without too much interference. Let me just check something here. Audio settings. There we go. I just want to see if I can. Okay, I guess it's okay. So I don't know if you're getting a lot of the noise in the background. Like I said, I was trying to filter that out, but looks like we're okay. Good. Sounds good. Okay, good. Anyway, I want to thank everybody for being here. Welcome, Brenda. Welcome, Kevin. Welcome, Will, everybody. So we'll go ahead and kick this off. Before we get started, just to remind you, we're not broker dealers or investment advisors. We're doing this from an educational standpoint. Basically, I joke, I say I'm genetically engineered to do this anyway because my mother is a retired school teacher and my father is a retired stockbroker. So if you blend the genes of a broker and a teacher together, that's what you get. Anyway, we're doing this for fun and for educational purposes. If I go ahead and talk about individual securities to show charts, I'm just doing it from an education, not recommending anything. And there's always risk of loss in the markets. Who knew? You can lose money. Anyway, we do what we can to minimize the risk and manage the risk, but we can never eliminate it. And we are also not subject to trading restrictions. We can have a position in a security or initiate one at a time. So I'm glad you guys can't hear the noise because it's really loud. There's like generators and water pumps and all sorts of things going on outside. So today, well, before we get started, we are very busy here at Wealth Builders HQ. As you can see, got Inner Circle, Mastermind Group, Trading You, all kinds of things going on. And I just finished a class, right? Yeah, Kevin said, good morning, good afternoon, Brandon. Long time no see. He just came out of a class about an hour ago. I do what's called the E-mini think tank every Monday, Wednesday, and Thursday from 9 to 11. And actually, see, there's all my programs. I have the E-mini think tank, well, spreads, SPX cash flow, futures boot camp. And what we're going to talk about today is gapping in the markets. And I use that mostly in the E-mini think tank class. So if you're interested in learning more about all those programs, obviously there's links available. Lee just put out the link there for the cash flow secrets. That's actually a options program that I do. But mainly what I'm going to talk about today is stuff that I'm going to be using pretty much in the E-mini think tank and stuff I teach there as well. You know, if you go into any of the programs, like I said, the E-mini think tank, if you can bring up that link, basically what happens is you've got education that's kind of self-paced education where you can learn at your own pace, as I said. Let me just do something here. Word. Have this open or not? Nope. Oh, there it is. There's the link for E-mini think tank. Thank you. Anyway, deal with that later. So, like I said, if I go into bonus material, you'll see bonus videos. There's educational videos. And one of those, if I can find it, so many videos. It is on gapping. It's actually in this one right here, Globex Traps. I talk about gapping as well. And actually in my documents that support all that, I don't know where exactly it is, but I do know there's a document on that. It's not new strategy, might be other strategy. Yep, there it is, Globex Traps and Gaps. So my students have lots of information. And the neat thing about the E-mini think tank is not only do you get to learn this stuff at your own pace, but then we go into the markets live and practice what you learn. So you get to see it in action 3 days a week. So for instance, right now, we're still sitting on this short in the NASDAQ, but basically what happened was there was a gap. You know, if I take out the after extended hours here, you can see that today we gapped up just a little bit right there on the NASDAQ and then closed the gap. So it was obvious it was likely to do that based on the type of gap it was. And if you understand, first of all, what gaps are, how they're caused, and more importantly, how to anticipate and take advantage of them, you're going to have an advantage over a lot of other traders. And you can do this very early in the morning, well, depending on where you live, obviously. I have some students that are in Europe, some in Asia, some in South America, one in Australia. So wherever you are in the world, you know, you can take advantage of that, and you're at the beginning of any market session. So that's what we're going to talk a little bit about is gapping, kind of what causes them, how to deal with them. And by having that edge, you've got a strategy that you can use pretty much on any market in the world. Not really Forex, unfortunately, because that doesn't gap. I mean, that's open nearly 24 hours a day, 6 days a week. So it's kind of hard to deal with that with gaps that don't really exist there. But anything else, futures, stocks, you name it, there's gaps, and there's things we can do to take advantage of it. Gaps aren't really random. We'll take a look right here. I go out to my browser or my charts, and I'll go to Apple. And actually, let's go to Tesla and see if there's gap there today. There's usually a lot of gaps on Tesla. Yep, there are. Not disappointed at all. Plenty of gaps. And these gaps serve a purpose. You got to think about it. For every buy order that you put in, there has to be somebody willing to sell to you. And if you're wanting to sell, there has to be somebody willing to buy from you. Otherwise, there's no transactions. So gaps are the market's way of sorting through imbalances between buying and selling pressure. Actually, let me go over to my Word document here and create a new blank document for us for some notes, because that'll help. So basically, gaps is the market's way of sorting it's basically sorting through those imbalances between buying and selling pressure. That's really what it is. That's all it is. The market's kind of sorting through that because you can't buy without a seller. And vice versa. You need a buyer to be able to sell. So you have to have somebody on the other side. Yeah, there's different types of gaps: exhaustion gap, continuation gap. I don't know about dirty gap. I haven't heard that one before, but I look at them a little bit differently than a lot of people do as far as the gaps and the types of gaps. So we'll take a look at that. What's this going on there? Then what's the period after, whatever. All right. This Grammarly that tries to correct me all the time. So anyway, basically, we're looking at these imbalances between buying and selling pressure. So usually what happens, and I used to do this for a living. I worked for a brokerage where I was what they call an agency desk operator. So what I would do every day is deal with the order flow coming in between my customers, or actually the brokerage customers. Broker would talk to a customer. It's back in the 1990s. So they would actually pick up the phone, call a customer, get an order, write it up on a piece of paper called a chit, and they would give it to me. And I would have to go ahead and plug in the order in the computer. If you remember the old CRT monitors that had just the green, it was no other colors but green. It was monochrome monitors. That's what I had. And I was dealing with market makers, who are people who were tasked with creating liquidity or making a market in whatever security it was. So what happens is, this is showing Tesla trading between, well, I'm on a daily chart. Let's go into, say, a 15-minute chart. That's usually where you'll see the gaps anyway. As a matter of fact, there's a lot of common gap types, and they can be played, as I said, for the high probabilities. We never know 100% what's going to happen in the markets. We can only play the highest probability based on the patterns we're seeing in those markets. And the patterns really reflect the price action that's happening from the participants in the markets. So I already said this can be done on stocks or futures, doesn't matter, it works on both. And basically, as I said, the gap is a break between where trading occurred to where it now occurs in the current day. So usually a gap occurs between the end of one trading day and the beginning of another. But it can happen intraday as well. You got to realize that charts only show you the trades that have gone through, that have occurred. So again, every piece of data on a chart has a buyer and a seller attached to it. But orders can be put in without getting filled. So if orders are being flooded in and canceled, and there's a trade that goes off of one price, but there's no trading that happens, and all of a sudden there's another trade that happens at another price that's totally different, you can have intraday gaps. That actually is a sign of an illiquid security. If I go out to, say, for instance, I can do it here. I was on Tesla, but if I go to ZO, should be oat futures, And this is a 15-minute chart. I'll make it even worse. We'll go down to a 5-minute chart. And notice throughout the day, there's intraday gaps going on here. Why? Because oats is a very thinly traded security. It doesn't have a lot of liquidity. It doesn't have a lot of volume. And that is a sign that maybe you shouldn't be trading it. If you want to trade intraday, perhaps you do something like corn that has a lot more volume, and now you don't have the gaps, right? So again, we'll go back to Tesla. And as I was getting into my story here, I was talking about why these gaps might be formed. Well, let's take a look at Tesla for this morning. You know, this typical chart is showing me regular trading hours. This ended at 4 p.m. yesterday. And now the first trade this morning is being shown at 9:30 in the morning. So most people are used to the markets, you know, for the equity markets, stocks basically, they're open from 9:30 a.m. This is Eastern time, obviously, to 4 p.m. Eastern Standard Time. And then in futures, you have two different sessions. Okay, one is called the regular trading hours, or RTH. That's HOU. Okay, and these are also considered the old pit hours. You know, in Chicago, they have the old pits. Actually, there are a lot of different places, not just Chicago, but they don't have those pits anymore. You know, the pits that people used to trade in, they would scream, buy, sell, all kinds of stuff. And it doesn't exist anymore. The pit hours, they vary based on what it is you're trading. So if you were to go out, if you want to see some of those, you can go out to website barchart.com. And if I go into futures and contract specs, contract specifications. So for instance, if I go to energies, you'll see right here, it shows West Texas Intermediate crude oil. And it shows 5 p.m. to 4 p.m. Sunday through Friday. This is Central Time, by the way. But then it says RTH, regular trading hours. The old pit hours are from 8 a.m. to 1:30 p.m. Central Time. Okay. So yeah, I can share the link. That's fine. It's just a free website here. Let's see if I can change. Hold on. Make it everyone. There you go. That happens to be energies. So if you're just going to the main page, you just take off that energies. Let's see. There. It goes to currencies by default anyway, so it doesn't matter. But anyway, like I said, it'll show you the difference between pit hours, regular trading hours, or what we call extended trading hours or electronic trading hours, ETH. Oops, extended trading hours. Oops. So that's ETH. And this is what's called the Globex system. I think it started in 1992, maybe a little bit. Yeah, it was 1992. Established 1992, because it was basically brought up in 1987. What happened was in 1987, the markets crashed and there was a lot of people who lost a ton of money. Basically, brokers stopped answering the phone because they knew it was going to be somebody trying to sell, and it was too frantic. So they were dealing with themselves and trying to save money for themselves and the brokers, and they didn't care about the customers. Well, people got mad about that and they complained to the government. So the government acted really quick. 5 years later, yeah, not so quick. 5 years later, in 1992, they actually established an electronic system called Globex so people could actually trade electronically and bypass the pit. So the Globex system is really almost 24 hours a day. All the trading that we do is on that Globex system for futures. But it mimics the pit hours and the pit trading, because all that pit trading gets reported as well. And now the pits are gone anyway. So really, there is nothing different between RTH and ETH, except there's heavier volume during the RTH, because that's when the institutions get to the computers. So all the trading that we do in futures are all done electronically on the Globex system. right? So when we take a look again at those pit hours, this is on currencies, so that doesn't show. But if you go to indices, maybe not, that doesn't show either. The RTH, here we go, grains. So again, if we go into grains, well, it doesn't show the difference, but this is the regular trading hours, 8:30 a.m. to 1:20 Central. And then there's the extended trading hours or electronic from 7 p.m. to 7:45 a.m. It really shows the best, like I said, on the energies. They literally show you RTH, or metals, I believe, shows it too. Yeah. So for instance, gold trades 5 p.m. to 4 p.m. It only shuts down for 1 hour every day. Starts on Sunday, ends at Friday. But between 8:20 in the morning and 1:30 in the afternoon Eastern, there happens to be the pit hours that has a little bit more, well, much more volume, honestly, not just a little bit, right? Let's take a look. Oops, wrong one. There we are. If I bring in volume here, for instance, there's the indicators, volume. Oh, thank goodness they turned off the machine for a bit. So here's the volume. And again, if I go into gold, so you just do continuous gold here, and you take a look between right here, there's volume. Again, by about 8:20, the volume jumped versus the pre-market. And then when you go back to last week, same thing. You can tell where the regular trading hours are by the bigger spike in volume compared to the extended hours. So going back to a stock like Tesla, we believe that, okay, the market's only open from 9:30 in the morning to 4 in the afternoon. No, it's not. It's actually available to trade many hours before and after that, but you have to manipulate your charts a little bit. So if I go into my settings here, and let me see under symbol, shows session, regular trading. Here we can go to extended trading hours. And I can actually change the colors a little bit. So what do we have there? Blue. What are they doing this one? See if that works. It's not very heavily shaded now, but you can see there's a shading that shows the pre-market and post-market. So I could have traded Tesla all the way up until Friday at 8 p.m. and gotten in as early as 4 a.m. today on Monday. But when you're looking at the charts, typically you're only seeing the regular trading hours. So if I go back to regular trading hours, there we are. And there's the gap down as we took out all the other trading information. Now, why did it gap down like that? Well, it has to do with those orders I was talking about. As a market maker, basically, or an agency desk operator, I come into the office every morning and there's a bunch of orders waiting to go for when the opening bell rings. Many people would be contacted in the afternoon or in the evening, or they would send an email or push a button on their computer to buy or sell at the open the next day. So perhaps there were a lot of people who watched Tesla dropping towards the end of the day on Friday. And they were upset because they were losing money because maybe they owned Tesla shares. So what they want to do is as soon as Monday morning opens, they want to sell before this gets worse. Okay, so just think about this. Right now, there's a lot of sell orders coming in. Oops, orders. Okay, so we got a lot of sell orders building up. Now, remember, if we have a lot of sell orders building up after this closed right there on Friday afternoon, people saw the end of the days, Tesla sold off. It was down a little bit. They're worried about the market. All weekend long, they've been worried about this, and they need to get that order filled immediately on Monday morning. Now, if there's a whole bunch of sell orders built up, what do we need to fill those sell orders? We need buyers, right? So here's the problem. If everybody wants to sell, where are the buyers going to be? Probably at a much lower price. So what market makers will do is one of two things. One, they can go ahead and buy from their customers, right? They can take the opposite side of what their customers are doing. So the market makers themselves, they may buy from their customers. Now, they need prices to go up if they're buying, right? Otherwise, they're going to lose money. Or the other thing that can happen is the market makers, I'll just say here, or what the market makers can also do, market makers can push bids and offers down to where the buyers are. So they don't necessarily have to buy. What they can do pre-market in that extended trading hours, none of the quotes that market makers put out, they're not obligated to fill those quotes. They can put out whatever quotes they want. They do not actually have to fill them. Once that bell rings at 9:30, though, they're obligated for whatever quote they put out there. They have to honor that for a certain number of seconds. Okay. And then afterwards, they can change it. So basically, if they want to, before the market opens, they can start walking down their bids and offers. And if people see some of the other market makers doing that, remember, they're not individual. There's a lot of market makers out there, and they see what other market makers are doing. They probably have the same types of orders. So if there's this huge glut of sell orders and no buyers, many of them are probably walking the prices down to where they can find a good area of demand where there may be leftover buyers. So as I go back in time here, we can see that way back here, there's an origin of a rally. That might be a good demand zone, perhaps, right about here. Or maybe even, I don't know if this was too high or not. Let's go back and see. Going back to my current day. Where are you? There it is. Oh, no, it wasn't. It was actually already used there too. So what I was trying to do is figure out, okay, where's that leftover buying pressure that maybe the orders didn't get filled. Notice there was a gap up here. So there's a lot of buying pressure in that area before that caused the gap up. And down here, there's also a lot of buying pressure. So it may not get their the exact location that they want, but it's going to get in the area. So either the market makers are going to go ahead and buy from their customers at the open, or they're going to try to push prices down until the market opens near where there's a bunch of buyers, and those buyers will automatically fill all those sell orders. So what happened today? The market opened up pretty much right into my demand zone, didn't it? Literally right at the bottom of the demand zone is where it opened. This is not random. Those gaps are not random. They're planned by the market makers. Okay. So if you can see where there's supply and demand in the past, you get a good idea of where prices are likely to go in the future, especially when they're going to gap. So here's the other thing to think about. When all those buy orders are filled, I'm sorry, not buy orders, all those sell orders are filled. Remember, the reason why we gapped this down was there was a huge stack of sell orders, nobody willing to buy. So either the market makers had to buy or they had to push prices to where there were a bunch of buyers. Once that's happened, and you've satisfied all those sell orders, prices can't keep going down anymore. So at this point, once the orders are filled, let me just bring this in, a little text here. Can't even spell today. I missed typing. Once the customer sell orders have been filled, the market makers let price go. Basically, and if there's no more buyers, there's a bunch of, no more sellers, there may be a bunch of buyers there. Or even if the market makers, remember, the market makers may have inventory. So what are they going to want to have happen? If they had to buy from their customers, they're going to want prices to go up. And that's one of the reasons why many gaps try to fill. So here it is, the market makers filling all those sell orders. Now they're stuck with a bunch of stock. They're going to keep trying to push prices up to fill the gap. And they did. They almost filled the gap right here, as you can see. So why did that occur? Why did that gap fill occur? Two reasons. One, all the sell orders were filled. They're no longer there to push prices down. Or number two, if the market makers were buying, they've got a lot of stock and they want to push prices up to make money. So that's what they're trying to do right there. And sure enough, prices eventually kept rising. So you'll see that gap fill quite often. So basically, again, a gap is simply an imbalance between buying and selling right there. It's how the market sorts through those large imbalances. we gap prices to where there may be leftover orders. Often it's a prior supplier demand zone. And if you want more information on supply and demand, of course, in the E-mini think tank, again, let me go back there. You can see that I've got under my fundamentals, where is it here? There it is, base leg zoning technique. I actually teach you how to find where those pockets of buying and selling orders are so you can identify where the turning points are likely to be. And of course, there's a video on this as well. And not sure where it is. There's targeting. There we go, training routine and finding zones. By the way, there's a lot of material, obviously, in the E-mini think tank. I actually have a document here, what is here. And that's where you really need to start if you join the program. By the way, if you're interested in joining the program, there's a 2-week free trial if you do quarterly subscription. So like I was saying before, you can go ahead and click on that link, that E-mini think tank link. It'll take you out to this. I'll copy it and paste it here again if you're interested in a link, but you can try everything out for free. You know, right here it says register, and there's a quarterly and a monthly. If you do the quarterly registration, you get 2 weeks free trial right there. So you don't even have to pay for 2 weeks. You get to try everything out for free, 100%. That's pretty cool. So anyway, getting back to the gaps, again, gaps are created sometimes by news, sometimes they're just regular buying or selling pressure and imbalance, or maybe an analyst makes a change in their estimations of what's going to happen in securities. So when we look at the gaps, the easiest way to see gaps is on smaller time frames, like 5 or 15-minute time frames. Hold on a sec. Okay, sorry about that. The workers are out there slamming some things around right now. So anyway, you want to see them, if you're going to see the gaps, you're going to see them easier on the smaller time frames because they'll be a little bit more pronounced. So there's different types of gaps that I look at. Again, many people are used to things like continuation gaps or exhaustion gaps. I don't look at them that way necessarily because sometimes it just keeps going when you think it's going to exhaust, and sometimes it exhausts when you think it's going to keep going. It just, you never know. So the 4 types of gaps I typically look at are novice gaps or pro gaps. A novice gap is a gap in the same direction as the current trend because pros don't chase price. They wait for things to go on sale. They wait for opportunities. Novices tend to chase. They see prices moving and they're worried about getting on board. Those gaps tend to close pretty quick. And the reason why is it's a great opportunity for the market makers to take money off the novices. You know, money doesn't come from nowhere. It's got to, you know, somebody has to lose so somebody else can win. So what usually happens is the novices get taken advantage of because they make the same mistakes over and over again. So novice gaps usually don't turn price. They just close and prices usually keep going. However, oh, here it is. There you see we're moving in this direction. We gap in the same direction. That's a novice gap. If that comes back, it's likely to fill that gap and keep going. Versus a professional gap. With a professional gap, they usually moves the opposite direction of the trend that we are currently in. And that's because there's that imbalance, kind of like what we saw in Tesla today. If I go back there again, well, actually, that was more of a novice gap, wasn't it? You can see we were trending down. We had a novice gap down. And when the gap filled, meaning the prices came back to the prior day's close, we didn't stop there, did we? We just kept going. And that's typically what happens. That's the novice gap. So pro gaps usually move the opposite direction. Let's see if we can find one of those. And it usually doesn't close very quickly. It stays open for a while. Let's see here. Novice gap there. That's, no, I don't know. Maybe you can see the trend towards the end of the day was down and we gapped up and prices couldn't fill the gap. It stayed open. In fact, it stayed open until we gapped beyond it. So that could be a pro gap where it's moving opposite of the overall trend. Although typically I like to look at a bigger picture for the trend. So right here, that was kind of moving up and that's a novice gap. So if it closes, it probably will keep going. Here's another novice gap. We were trending up, we gapped up, filled the gap and kept going. Here's a pro gap right there. We're moving up and we gap down. That gap stayed open for a while. Okay. So novice versus pro, the pro gaps usually stay open for a while. And if prices do try to come back to them, it'll usually cause a reversal. So they'll act as a barrier, kind of like support or resistance or supply and demand, if you will. So pro gap is opposite of the trend typically. The other type of gap, and this one I actually follow a little bit more, it's called inside gap versus outside gap. With an inside gap, you basically open the current day inside of the prior day's price action between the high and the low of the prior day. So again, you just have the prior day's high and low that you mark off, and today's opens within that prior day's price action. They usually try to close pretty quickly. Usually within the first 15 to 45 minutes of the trading day, prices will make a move to close that gap. And again, closing a gap is nothing more than coming back to the prior day's closing price. So right here, you can see there's an inside gap where we gap up, not above the prior day's high, and prices turn around and close it pretty quickly. Or there's a gap down inside of the prior day's price action, we close the gap. So like I said, with Tesla, we can identify inside or outside gaps by just understanding. Let me do this real quick. Settings. Let's see, do I have trying to find the lines that'll give me for the sessions. I don't have it. Where did I put it here? Scales. Trying to remember. There's a vertical line that you can get for the beginning of the sessions. I'm just trying to remember how to put it back on. That's session breaks. There it is. That's what I was looking for. So notice there's vertical lines now at the beginning of each day. So it makes it easier to be able to identify the high and low for each day. Now, it's not perfect, but actually, let's go all the way back to the beginning here and clean this chart up first. Well, not necessarily beginning, but just go back a little bit. So that way we can judge whether or not we're getting inside or outside gaps. No real gap there. It's not much. So we go to the end of this day and no real gap there. Go to the end of this day. There's a gap. So all I have to do to figure out if it's inside or outside is simply draw lines. Horizontal line at the top of the price action, horizontal line at the bottom of the price action. That is easily an outside gap. We gap below the prior day's low. So right here, outside gaps either open below the prior day's high, or I'm sorry, above the prior day's high or below the prior day's low. So either open above the prior day's high or below the prior day's low, and that's an outside gap. You're outside of the prior day's price action. So this is an outside gap. There's my open below the prior day's low. What happens with those gaps? They tend to stay open. They usually don't close on the same day. As a matter of fact, they often give you a trade opportunity on those. So what'll happen over, actually, I'm going to just take a look at a few more gaps here first with you. So that's an outside gap. We go forward. That one actually did fill. Again, everything happens except when it doesn't. So you can't say it's always going to do it. It's just the probabilities. So here's the next day. There's an inside gap, right? I say it's inside because there's the high. There's the low of the prior day. We are inside of that day's price action. And that one didn't fill at all. Okay. So like I said, it doesn't necessarily always work out. It's just the highest in probabilities. Here's another gap. Nope, that's not the high. There's the high for the day. There's an outside gap. That one filled. So again, it just depends because there's different probabilities depending on the types of gaps they are. No real gap there. Let's go on to the next one. No real gap there. Go to the next day. There's a gap. That's an inside gap. There's the high. There's the low. We gapped inside, should fill. Filled very quickly. So what I mean by probabilities is this. You know, we got inside, outside, novice, and pro. Those are the different types of gaps we have. So if you have an inside novice gap, should close because it's not inside gap. They close very quickly, but it might keep going. Remember, inside novice closes quickly and prices keep going. They're very weak gaps. A lot of people call them continuation gaps because you're gapping in the same direction prices were going, but it doesn't continue. It exhausts. So actually, I guess it's an exhaustion gap. That's the weakest gap, inside novice gap. You gap in the same direction you were already traveling, but you don't go above the prior day's high or below the prior day's low. However, if it's an inside pro gap, inside pro, it should close quickly, but it may actually turn and bounce. Therefore, that area acts as like a supply or demand zone. If we have an outside gap and it's a novice gap, it should close because it's an novice gap, but it should also turn and bounce. And then we have the outside pro, which generally doesn't fill. If it does try to fill, it usually gets a reversal almost immediately after. So the weakest type of gap is the inside novice. The strongest gap is the outside pro. Now, there's a little caveats I put on all this because, when we're looking at gaps, for instance, if I'm looking at the NASDAQ futures, I was trading that as well, that's a totally different strategy, but I have to take a look at what's going on with the 4 US equity indexes, the Russell, Dow, NASDAQ, and S&P. You see right here, I've got one chart where I'm comparing all of those indices together to see how they're doing. And I see which one's leading or lagging. The reason why I bring that up is if I'm looking to play the gaps, I need all 4 of those markets because they're so highly correlated. I need all 4 of them to be doing the same type of gap. If they're not, it lowers the probability of the gap play working. Stocks is not as important, although the stock should be doing the same thing as the index that it's working under. For instance, Tesla, oops, wrong page. Tesla is a NASDAQ stock. So it should be doing the same type of gap as the NASDAQ, maybe even the sector, if you will. So right there, this was on the 29th of June going into the 30th, and we had an outside, nope, I take it back. That's an inside gap. It opened just inside. Well, trend was going kind of sideways. So I'm not sure if that's a pro or a novice gap, to be honest with you. I'll say novice because we're kind of moving up. So we got an inside novice gap. That is the highest probability of filling, right? Where is it here? Inside novice. It should close, but not bounce when it closes. So let's see what happens. In this case, we actually stayed open. We never closed on that day. All right. So again, it's just about probabilities. It's not going to work every time. Here's another gap. That's obviously an outside gap. Didn't fill the gap. No real gap there. We move on to the next day. And here's another gap. Now with this gap, it is inside. Oops. But the trend was up. So it's an inside pro gap, right? We're inside the prior day's high and low, but we were trending up and we gapped down. So inside pro, it might close and it should bounce if it does close, meaning if we come back to the prior day's close, we should turn around and go back down again. What happened on that day? It tried to go into the gap and close. Couldn't get enough power to actually do it though, as you can see. Okay, well, next day. I'm getting a lot of exceptions on Tesla. Maybe I should use different security. Anyway, there's an inside gap. We didn't really have much of a trend again, so I don't know if that's really a pro or novice gap, but it's an inside gap, so it has a higher propensity of closing, and there it did. It actually closed the gap. You just got to figure out where it's likely to turn. Now, one thing, I'm not sure if I marked it on here or not. Yeah. For trading inside gaps, usually what will happen is with the inside gap, we know it's got a high probability of closing. What we need to do, though, is figure out where's it going to turn. It will usually turn at a supply or demand zone. So again, that's why I teach that a lot, and I focus on that a lot in the E-mini think tank. So if you're not familiar with how to identify those supply and demand zones, as I said, in the E-mini think tank, there's lessons on it right there, leg-based zoning technique. I haven't done it. I haven't changed it in years because it works, obviously. So I've got not only the video on it, but the documentation that backs it up. That's the document. Sorry. The video is up here under bonus videos. So you can learn how to find those and increase your probability for success in the E-mini Think Tank program. So inside gaps, let's say here we have an inside gap up. What will happen is prices will run to a supply zone and then turn and close the gap. And if this were a pro gap, well, I guess we were downtrending, we gapped up, it actually bounced from that area. Or if you gap down, but again, it's an inside gap, prices will look for an area of demand, then try to close the gap. So you can look for that opportunity to close the gap. For example, let's see, is it on my NASDAQ chart? Yeah, here looking at regular trading hours, there's the NASDAQ from today. I'll go down to a 5-minute time frame, which is probably better on a security. I don't have my stops in place, but that's okay. Right here, you can see we had a gap up this morning. There's the open for the current trading day, the bottom of that green candle. This is the prior trading day. This is Friday's price action. That's inside, isn't it? So what happened? Prices sought out a supply zone. Right there where that blue candle is, rally, base, drop. That's my supply zone. It overshot it a little, but once it came up to supply, what happened? Prices closed the gap. There's an inside gap, higher probability. And of course, it works best if all 4 of those equity markets are doing the same. Now, outside gaps, this is just showing more inside gaps. Once again, you look for an area that's going to turn, supply or demand, and target the gap fill. Pretty easy trade, right? If we go out to get off of Tesla, try something different. Let's go Apple. Yeah, it really doesn't matter what security you trade. As long as you have the gap opportunity. Well, that's an outside gap, so that's not going to work. You see, do we have more insides? There we go. Here's an example of a good inside gap. Right there. Okay, we have the prior day's high, prior day's low right there. There's the open. Let's see. There's the open right there. And the gap closure target would be right there, the prior day's close. So how are we going to get there? Well, we need to go to an area of demand and then look for a bounce. Well, it turns out it looks like we gapped into, it's not the best of demand zones. We were there for quite some time. So looking back a little bit, there may be some better areas. No, it's not very strong. This one might be a little better. Still not great though. I don't know if I would have traded this one. The time frame around 5 minutes. You can see the prices did pull back a little bit right to that zone. As a matter of fact, look at that. It's rally base rally that I marked off. And as soon as it came down to that area, that's the buy opportunity with the target being the gap closure. So how'd that work? There's the buy. There's the target. It worked. Will it always work? No, of course not. But again, it's about the highest probability. So that was the inside gap that filled. Let's see if we got another one here. Let me clean my chart. Look for another inside gap. And that one's kind of weak. Very small inside gap. Notice it's in the opposite direction. So that's a pro gap. That means that once the gap closes, it might actually turn price around as well. There's the target to get in or to get out. To get in, well, we have a supply zone here. Looks pretty good. And maybe a little bit higher as well, although that is simply a retest of this prior area. So that I probably wouldn't use. So there's my possible short opportunity with my target being the gap closure. And you can see, tried to, couldn't quite fill the gap though. This one didn't work. It started to, got about halfway there, and then would have stopped me out at break even. Once I get halfway to my target, I start moving my stops anyway. Again, I got rules for everything. The reason why is if you continuously use rules, you can build consistency in your trading. And with consistency comes profitability. If you're doing something different every time you get in the markets, you're going to have trouble. You might make some money, you might lose some money, but you don't have any consistency. So that's what we need is consistency in the markets. Rules help us with that. If I go into, again, this is all rules. Going to my documents and videos, you'll see plenty of rules set up for us, including gaps and what else we're supposed to be doing. So trading outside gaps. Again, inside gaps, we typically look for supply or demand zone and trade for that gap fill. The outside gaps, as I said before, that one doesn't try to fill. What will happen is if it gaps above the prior day's high, usually you'll bounce off that high. Or if it opens below with an outside gap, you'll usually bounce off the prior day's low and drop. So you can use that as a trade opportunity. I usually use 5 minutes for the time frames. So right here, there's you see a gap up on a Friday, and it came back and bounced off Thursday's high. Or in this case, from Thursday to Friday, we gapped down below the low, and it used Thursday's low as a bouncing point, and that's a good short entry. So with outside gaps, prices tend not to fill the gap, but bounce off the prior day's higher low. So here's another example of it, live market that happened on the NASDAQ. You can see there was the prior day's low, and we opened with an outside gap, bounced off the prior day's low, and kept going. So I can use that prior day's low candle on a 5-minute time frame for my entry and my stop. Or here, there's the prior day's high. I use the high and low of that candle, gapped up outside, closed the not the full gap, but part of the gap to the prior day's high, and bounced. So once again, if I go back to my chart, let's see if we got some outside gaps to trade. Nope, not there. There it is. That's a big outside gap, right? I happen to be on a 5-minute chart. Here's the high from the prior day. So I marked the high and low of that candle. I don't know if this one will fill that day, but if it does, this would be a buying opportunity. And of course it didn't. Okay, keep going. This one was an outside gap that actually filled. Here's the prior day's low. There's your gap down. But as you can see, it filled the gap. Well, it was a novice gap, wasn't it? We had a pretty good sized move down, paused in the afternoon, and gapped in the same direction. So that was a weaker gap. The best gaps to trade this are outside pro gaps. Let's see what kind of gap do we have coming up here. There we go. Outside gap. Let me clean this up. So there is my prior day's low right there. And we couldn't quite get there, unfortunately. Let's see if it gets there by the end of the day. There it is, coming up to the prior day's low. There's an outside gap, and it should likely bounce off that area. It looks like the momentum's shifting a little bit, so it might not work in this case. And you can see it didn't. Well, here we have an inside gap now. I know it's inside because there's the high, there's the low. We had a small inside gap. That will run to an area of demand or supply and close the gap. Looks like we actually opened into one right there. There's also another area down here. What happened? Pretty much closed the gap almost immediately right there. Didn't even turn at our demand zone, unfortunately, went a little bit lower. I guess this might have been a zone. Drop, base, rally, and that worked. I missed that one. But that's an example of an inside gap. If tried to find a demand zone, it's actually one that had already been used. It went a little deeper and then tried to close the gap. Eventually did close the gap fully. And it wasn't really a good demand either. Okay, we'll keep going here. And by the way, I don't expect you to remember everything I'm going over right now. This is a lot of material that I'm doing very quick, isn't it? So you're not going to be an expert just watching this video in 1 hour. You need a lot of practice with this. So as I said before, you can get that practice in the E-mini Think Tank. If you would want to join me there, there's monthly subscriptions or quarterly. Like I said, with the quarterly subscription, if you click on that, you get a 2-week free trial. We don't even charge a card for the first 2 weeks. You get full access to everything. Try it out. And if you think it's something that's going to help you, having a mentor like myself working with you, on a regular basis, pointing out these things in the markets, then you stay. If not, no big deal. Move on. So again, moving forward here in Apple, the next day, there's a gap down. It is an outside novice gap. I say that novice because we're trending downwards and we gap down. So it's unfortunate because it's an outside gap. Usually that means this prior day's low is going to act as a supply zone and push prices. That's a short entry. But because it's now a novice gap going in the same direction, it may be a little weak and might try to close. Let's see. It actually never got there. Oh, well, that's the closest it got. Let's find another gap. There we go. Definitely an outside gap. As you can see, here's the prior day's high. Came close to it, couldn't quite get there. Oh, there it is. Now it's bouncing, but the trend might have shifted a bit. And it went pretty deep in, but then moved up by the end of the day. So if you had bought this demand zone, yeah, it might have made a little profit. It wasn't great though. Next day, inside gap, opening inside the prior day's price action. Supply right here. Let's see. Oh, that's a zone too. So not only did we open up with an inside gap, but we opened into supply, although there's not a whole lot of profit potential to the prior day's close. So I might not have traded that. And there it is, close the gap. So yeah, it might have been an opportunity here to short at the supply zone. Stop goes above. Here's your target, by the way, as I mentioned. Right there. So that one worked. Let's see if we got another gap here. Another one, inside gap. It's relatively simple. You just take a look to see, is it inside, outside? Is it pro or novice? And I don't really have a great zone here. There is a lot of buying pressure that picks up right here. I hesitate to call that a good demand zone, but it is the origin of a lot of buying pressure. That's why we open there. It's an inside gap, and there's your fill. It works pretty well. And like I said, if I go into, let's see, RTY, it's a Russell 2000, but we can look at simply regular trading hours instead of overnight hours too. So again, just going back to a random date and time. No gap. What I do with the futures is take out the extended hours. So I'm only looking at regular trading hours. Here, we have an inside gap. It's inside a prior price action. There happens to be a demand zone right there. Perhaps this as well. Gap filled. Didn't make it down to my demand, unfortunately. And it filled. Next gap. Whoops. Nope, nothing there. Next day, there's a gap. Outside gap. So if once we see that outside gap, I look for the high of the prior day, mark off the high and low of that candle, and wait to spring the trap. If it comes down to close, there it is. That's the buy opportunity. As long as the trend is in my favor. And remember, with the Russell, I need the NASDAQ, the Dow, and the S&P to also be doing the same type of gap. If all four are doing an outside gap, this is going to be a high probability buy opportunity. And look at that. That ran up a nice 16 points. That's $50 a point, right? So what do we got there? 16 points times 50. That's an $800 move right there to that high. And then by the end of the day, it trailed off just a little bit. Look at that, came all the way back actually by the end of the day. That's why you got to have targets and trail stops too. But how neat was that? Nice and clean. So let's look for another gap. There's another one. Oops. What was this? Monday, July 3rd. That's a holiday, so that's not going to work as well. You need regular trading days. This is an inside gap, so it should fill. Where is it going to go before it fills? It's going to look for demand. We happen to have a demand zone here. Not a very good one, though. Better here. You can see that first one didn't hold very well, did it? I said it wasn't very good. And unfortunately, never got to our other demand by the end of the day. That's definitely an outside gap. I don't see it coming back though. Nope, never did. Go to another day, another gap. Nope, nothing there. There we go. That's a weird outside gap. It's kind of a novice outside gap because we're moving up, so it should fill pretty quick, and it did. But notice it turned around right after, but it actually hit this demand first before it bounced. Anyway, it wasn't much of a gap to really worry about. There we have a big outside gap. Here's the high. And I couldn't get there. Yeah, I can do the Qs. QQQ, you mean? So right here, for instance, this is from Monday, the 17th of July, and we have an inside gap. So we should fill that gap. Where would it turn? Demand. Here we have drop base. There's your rally up. Actually, that's not a fresh zone, so I can't use it. This was the origin of the zone back here. You can see we're coming into it, so it goes deeper. It actually went through and closed the gap, but it went a little deeper first, so I had to have a little more leeway. So moving forward, no real gap there. There we have an outside gap again. Outside gap on the Qs, therefore the prior day's low should be the bouncing point. This is also a downward trend, so it's kind of a novice gap, a little bit weak. But look at that, we couldn't even get to the prior day's low and it already dropped. So I wouldn't have made any money on that one, but it obviously dropped pretty well. And if on that day, the other markets were doing the same thing, there might have been a trade on the Dow or the Russell or the S&P instead. Now we have an inside gap. Looking for my supply zone. This is definitely selling pressure, but I don't think it's a great supply zone. Keep an eye on this area, but this is definitely the better zone up above. Let's see. Nope, it just opened up and closed the gap right away. Okay, no big deal. Just trying to see. This really wasn't a good zone though. It overshot it a little, but that's where we opened up, right in that selling pressure. Anyway, continuing on, next day, what's this, 21st? That was Friday. And then today, there's our gap up, inside gap, right? So if this is an inside gap, it should turn at supply. We have that supply zone, looking left and up. That's not really a good zone. That'd be the next one right there. And you can see that was a test of it. So here's our move into that zone, should potentially turn here. And there it is. That was the gap fill this morning. So that was the opportunity. Now, again, it overshot it a little, so you got to have enough room on your stop loss. I typically use average true range to help me out with that. But that's what happened. We filled the gap on the Qs today. So that is a little bit about how the gaps work. Again, they're caused by that pre-market activity by the market makers. Market makers usually start working about 8 a.m. That's where you start to see the volume pick up 8 to 8:30. So by 9:30, they've already done a lot of trades and set themselves up for what they expect to happen in the markets for the day. And if you can understand where these gaps are and identify them, you have a higher probability to figure out which way it's going to go, either fill or not fill, where to buy and where to sell based on the zones. So like I said, I would love to have you join me in the E-mini think tank eventually if you're ready for that. I put the link out there a few times. Lee's got it again. Thank you very much. I got to get going. It's already 1 o'clock and I got to set up for another thing that I'm doing today, which is my SPX cash flow for this options trade that I do every day. But that's something else we'll talk about another time. So I want to thank everybody for being here. Until next time, trade safe, trade well, and take care. Thank you, everyone.